In August 2025, the United States government did something it almost never does. It bought stock. Not treasury bonds, not land, stock. 433 million shares of Intel at $20.47 a share. Total cost, $8.9 billion. This week, that bet is worth $36 billion. That's a $27 billion paper profit, a 300% return. The single largest unrealized government investment gain in tech history, and almost nobody is talking about it. Here's how a struggling chip company, a controversial government subsidy, and one monster earnings report combine to create the most insane trade of 2026. To understand why the US government owns Intel stock in the first place, you have to rewind to 2022. That's when Congress passed the CHIPS and Science Act, a $52 billion package designed to bring semiconductor manufacturing back to American soil. The logic was simple. Over 90% of the world's advanced chips are made in Taiwan, primarily by TSMC. If anything disrupts that supply, a Chinese blockade, a natural disaster, a pandemic-era shortage like the one that crippled the auto industry, the entire global economy grinds to a halt. The CHIPS Act was America's insurance policy, and Intel was the centerpiece. Intel got the largest single allocation, $8.5 billion in direct grants, plus $11 billion in loans. But the deal had a catch that nobody paid attention to at the time. As part of the agreement, the government received equity. 433.3 million shares of Intel common stock, purchased at $20.47 per share. The US government became one of Intel's largest shareholders. At the time, this looked like a terrible bet. Intel was in freefall. The company had lost its manufacturing lead to TSMC. Its data center business was getting demolished by Nvidia. CEO Pat Gelsinger had been forced out. The stock hit $18 in late 2024. Critics called the CHIPS Act a bailout for a dying company, Congress literally buying stock in a loser. But the government wasn't making a stock trade. They were making a strategic bet on American manufacturing capacity. The equity stake was just a bonus. And then Intel did something nobody expected. They got their act together. Intel's turnaround didn't happen overnight, but the Q1 2026 earnings report was the moment everything clicked. Revenue, $13.6 billion. That's up 7% year over year, and it crushed Wall Street estimates. Earnings per share, 29 cents. Analysts expected a 1-cent loss. Intel didn't just beat expectations, it obliterated them. Three things drove the surprise. First, Intel 18A. Intel's new manufacturing process, its most advanced ever, is now in volume production. This is the node that skeptics said Intel couldn't build. Samsung tried and failed. Global foundries gave up on leading edge entirely. Intel pulled it off, and the first chips are shipping to external foundry customers. That's the part that changes everything. Intel isn't just making its own chips anymore. It's making chips for other companies, directly competing with TSMC for foundry business. Second, the data center recovery. Intel's server CPU business had been bleeding market share to AMD for 4 years straight. Q1 2026 was the first quarter where that trend reversed. New Xeon processors built on Intel 18A are winning back enterprise customers who'd switched to AMD because Intel's performance per watt is finally competitive again. Third, and this is the part Wall Street loved, Intel's foundry pipeline. The company disclosed $18 billion in committed foundry contracts for 2026 and 2027. That includes deals with Qualcomm, Amazon, and reportedly, Apple. Intel is turning into the thing the CHIPS Act was designed to create, a domestic alternative to TSMC. The stock surged 24% in a single day, one of the biggest single-day moves for a mega-cap tech stock in years. And that surge is what turned the government's $8.9 billion stake into $36 billion. Let's do the math, because the numbers are genuinely staggering. The US government holds 433.3 million shares of Intel. It paid $20.47 per share. After the earnings surge, Intel is trading around $83 per share. That puts the government's position at approximately $36 billion. Cost basis, $8.9 billion. Current value, $36 billion. Unrealized gain, $27 billion. Return, over 300%. To put that in perspective, $27 billion is more than the entire annual budget of NASA. It's more than the US spends on the FBI, the SEC, and the FTC combined. It's larger than the GDP of over 100 countries. And the government hasn't sold a single share. Now, this is unrealized profit, meaning the government hasn't locked in these gains. If Intel's stock drops, the paper profit shrinks. But even if Intel fell 50% from here, the government would still be sitting on a significant gain. The bigger picture is what this means for the CHIPS Act as policy. The program has been under relentless political attack since its passage. Critics from both parties have called it corporate welfare, picking winners, and wasteful industrial policy. The fact that the government's equity stake alone has generated a $27 billion return doesn't just justify the Intel investment. It covers the cost of half the entire CHIPS Act program in one position. That's not how government investments usually work. The Department of Energy's loan guarantee program famously lost $535 million on Solyndra. The Treasury's TARP investment in GM during the 2008 financial crisis lost $11.2 billion. Government as investor has a lousy track record. The Intel position is the exception that changes the argument. But this isn't really a finance story. It's a geopolitics story. The entire point of the CHIPS Act was to reduce America's dependence on Taiwanese chip fabrication. That threat isn't hypothetical anymore. China has conducted 3 military exercises around Taiwan in the last 18 months. The Pentagon's latest war game scenarios assume a Chinese blockade of TSMC within the next 5 to 8 years. If that happens, every AI data center, every smartphone, every car, every military system that runs on advanced chips faces a supply crisis. TSMC makes over 60% of the world's semiconductors and over 90% of the most advanced ones. There is no backup plan unless you build one. Intel 18A in Arizona, Ohio, and New Mexico is that backup plan. The fabs are being built with CHIPS Act money. They're on American soil. They're staffed by American workers, and they're producing chips at the leading edge. The $27 billion profit is a nice bonus, but the real return is strategic. If the US government had to build this capacity from scratch without Intel, without an existing company that already had the engineering talent, the IP portfolio, and the manufacturing infrastructure, it would cost far more than $52 billion. The irony is that Intel's stock price had to collapse first for this to work. The government got 433 million shares at $20 because Intel was in crisis. If Intel had been healthy and trading at $80, the CHIPS Act equity stake would have been a fraction of the size, and the strategic leverage would have been minimal. The US government accidentally timed the bottom on one of the most important tech stocks in the world, and the taxpayer profit is $27 billion and counting. This is one of those stories where the reality is stranger than anything you could make up. The United States government, an entity famous for overpaying for everything, made the single best tech investment of 2025 by buying stock in a company that everyone on Wall Street had left for dead. $8.9 billion in, $36 billion out, and the chips are being built on American soil. If you found this useful, hit subscribe. We break down stories like this every single day. And drop a comment. Did the CHIPS Act just prove that industrial policy actually works? I want to hear your take. See you in the next one.